All right, so I've been away for a couple weeks, and my God, it has been quite the drama show in the stock market. We got the majority of bank and tech earnings done. We're about halfway through earnings season, and it has not been great so far, along with the terrible jobs data made for a massive broad market sell-off last week, and we've recovered for the most part this week, but not completely. I haven't been able to make any earnings reactions videos, so I'm going to put 3 in one. We're going to talk about Palantir, then SoFi, then PayPal. That's in order of my largest to smallest position of those 3. Of those 3, I've got the most amount of money in Palantir, second most amount of money in SoFi, and the least amount of money in PayPal. All 3 of these companies reported earnings within the past week, and we're going to dive into all the specifics of what I was looking at, potentially any updated price targets, whether or not I'm still buying, holding, selling, etc., what I'm doing with these 3 stocks in this video. And for those who want to skip around, I'll put timestamps for each of the 3 stocks that we're going to talk about. I'm excited to dive into this one, but first, if you're not subscribed already, become one of those 4,500 or so people. Help us on that short-term goal of getting to 5,000 subs. I appreciate that in a major way. Thank you so much. Let's jump into the first stock, which is Palantir. So they reported earnings, and on the earnings day, the stock popped over 10%. Then it had a little bit of a chill day, and here today, once again, the stock is up over 10% on the day. So the market reaction to earnings is certainly positive, and I want to share all the great things that happened in Palantir's earnings in Q2. There's one thing I think is responsible for the extremely positive market reaction to Palantir. Palantir is sitting right around the $29 mark, and it's not going to be long before we see the stock break 30. Let's jump into the earnings and first look at the headline numbers. So in Q2, Palantir reported 27% year-over-year revenue growth. They raised their full year revenue guidance, and they had record GAAP EPS of 6 cents per share, highest ever, and that's up 500% on a year-over-year basis. U.S. commercial revenue growth was up 55% year-over-year. U.S. commercial customer count was up 83% year-over-year, and U.S. commercial remaining deal value grew 103% year-over-year. And we're also really starting to see that government revenue accelerate as well, and it was up 24% year-over-year. They posted record GAAP net income and record GAAP operating income. Net income was $134 million for the quarter, which was a 20% margin, and then income from operations on a GAAP basis was $105 million for the quarter, which is a 16% operating margin. And another record for the company, Rule of 40 score all the way up to 64%, which is the highest in the company's history since they've been public. And as we know, they've kept the balance sheet absolutely bulletproof. They have over $4 billion in cash equivalents, and short-term investments with no debt on the books. Absolutely ridiculous. I can't say enough about the bulletproof balance sheet Palantir has and their ability to weather literally any economic time that we go through. Revenue for the quarter was $678 million, which, like we said earlier, was up 27% year over year. I want to take a sec and talk about these year over year revenue growth numbers. So in 2020 and 2021, we had absolutely ridiculous revenue growth numbers. In some quarters, it was higher than 50%. Many other quarters were higher than 40%, and then other quarters were in the 30% range. Those are extremely high revenue growth rates on a year over year basis. And then as the Fed started their tightening cycle, Palantir's revenue growth rate was hurt in a massive way. Check it out here. In Q4 of 2021, their revenue growth rate was 34.39% year over year. And then you fast forward 1 year from that, Q4 of 2022, 17.5%. And then you fast forward 2 more quarters and it hit a low of 12.75% growth. For a growth company, that is not what we wanted to see. I was making content in that time talking about how this was certainly a sore spot for Palantir, and they needed to re-accelerate that revenue growth in order to get the story behind Palantir again, to get the stock price moving in the right direction. That has definitely happened. Check it out since that low of 12.75%. The very next quarter, they were up to 16.8. After that, 19.6. After that, 20.7. And now this most recent quarter, 27.15% growth. So not only do they have 7 quarters in a row of GAAP net income being positive and positive income from operations on a GAAP basis for 6 quarters in a row, but also they're re-accelerating the revenue growth and demand is increasing for their AI products. Palantir is in the best possible position for a long-term investor. All the great fundamentals underlying the business, and now that revenue growth accelerating, I think that's the main thing that's causing the positive reaction and a bunch of money to flow into Palantir Palantir, and of course the continued AI trade, because the AI demand is clearly immense for Palantir's AIP, the artificial intelligence platform. What's really allowed Palantir to accelerate that revenue growth so much and absolutely kill it in the US commercial growth is the AIP and shortening the sales cycle for all commercial customers. In their Q2 business update slides, they provided a slide that says prototype to production, accelerating the US commercial customer journey. And they've got 3 examples here. Large wholesale insurance brokerage firm, 16 days to 7-figure 2-year deal. That prior might have taken months in order to get that 7-figure 2-year deal. Second example, leading global life sciences company, less than 6 weeks to a 7-figure ACV deal. And then their third example, leading convenience store chain, 25 days to paid pilot and conversion. Their plan with the boot camps is to shorten that sales cycle substantially, and it's definitely working with those US commercial growth rates being so ridiculous. Check them out. These are all US commercial growth numbers: 55% revenue growth, 83% customer count growth, 103% remaining deal value growth, 98% increase in deals closed, and 152% increase in US total commercial contract value. The management team is executing their vision beautifully. Demand is there, the revenue growth is accelerating, the net income is there, the operating income is there. Net income, it's been 7 quarters in a row. Operating income, it's been 6 quarters in a row on GAAP basis for both of those. They exceeded my expectations for Q2. I am certainly a happy shareholder. It's a very, very large position for me. It's somewhere in my top 3 holdings. It depends on the day where the position moves. I'm probably not going to be buying any Palantir in the near term. I have more than a fully built out position. It's an extremely heavy weight for me, but I am holding 100% of my shares. I'm not even thinking about selling 1 share. I'm extremely excited to hold this stock for the next decade at least. Next stock up here that we're going to talk about is SoFi. They also reported earnings recently. The market reaction to SoFi's earnings has been pretty much flat. It wasn't overly negative. It wasn't overly positive. It kind of just was chilling the day that they reported earnings, which is fine. The earnings were pretty mixed as far as the things I really wanted to see and the things we didn't quite see, but there's a ton of great things in here, and I think it leans overall toward the positive for Q2. If we look at year-over-year revenue growth, it's still up 20% in comparison to Q2 of 2023. That 20% number is definitely lower than what we're used to seeing SoFi report. The revenue growth rates have dropped substantially over the last few quarters because we're in a tighter lending environment, and the majority of the revenue still is coming from the lending segment for now. So I'm not surprised that the revenue growth rates are down, but it's not the best thing to see for investor sentiment for a growth stock like SoFi. Great thing to see is that they are consistent now on reporting GAAP profitability. They've got 3 quarters in a row of GAAP EPS being positive. And they actually raised some parts of their 2024 guidance. We'll get into that here in just a little bit. In Q2, we hit an all-time high in members, 8.77 million, an all-time high in products, 12.77 million, and an all-time high in technology platform connected accounts, up to 158 million connected accounts on the tech platform. And look at the growth for the last 5 quarters in technology platform connected accounts: 129 million up to 137 million, 145 million, 151 now up to 158. It's really good to see that growth extremely consistent in those technology platform connected accounts. All the numbers for the tech platform are certainly in focus to be valued as a fintech company rather than being valued as a bank. If they're going to be valued as a bank, they're going to command a much lower valuation in comparison to if they're valued as a fintech company. Tech companies, fintech companies command a much higher multiple than a bank stock. We want SoFi to be viewed by the market as a fintech company. So the more amount of revenue they can bring, the more amount of connected accounts they bring, the more amount of income from the tech segment that they can bring, the better for us. So every single time they report earnings, the very first thing I look at is tech platform numbers. Checking out lending growth real quick. In this quarter, we actually got 5% revenue growth from the lending segment, which is a nice sign. It's exciting to see. And I think we're getting a much clearer picture of the lending side of the business, which is going to make Wall Street happy, because right now, the majority of the revenue for the company is coming from lending. And certainly the majority of the profit for the company is currently coming from lending. So that's what Wall Street cares about in the short term. And me and you, we might be focused on the next 3 to 5 to 7 to 10 years. Wall Street is typically worried about the next 6 to 12 months. So in the next 6 to 12 months, when lending gets in a better spot, SoFi stock price is probably going to take off. I am glad to see that we have 5% growth on a year-over-year basis in the lending segment in Q2. as rates come down, and it seems like they're going to come down pretty soon and pretty fast, it's going to really boost SoFi's lending numbers for the positive. When we look at origination volume for the three different types of loans, personal loans, student loans, and home loans, they're all up very impressively. 12% increase in personal loans year over year, 86% increase in student loans year over year, which isn't surprising because the moratorium ended. And then home loans, the shining star to me, up 71%. And this is with rates at extremely high levels. We're certainly not in a booming housing market right now. So to see origination volumes up 71% for the home loans for SoFi is really exciting for whenever we do get back into a hot housing market. Moving on to tech platform results, I got some awesome stuff to show you. Check it out. Year over year, we got a 9% increase in revenue for the technology platform, but that's while we have a 9% decrease in directly attributable expenses, which, as you know, that's going to make the contribution profit absolutely explode. And that is what happened. 82% increase year over year in the contribution profit from the technology platform, up from 17 million all the way to 31.1 million. That's what we need to see. Even if we have that slightly lower revenue growth than we'd like to see, I would definitely like to see that revenue growth in the 10, 15, 20% range for the tech platform. But even if it's a little lower, as long as they're still running the business lean and bringing those expenses down, the profit from that segment is going to continue to explode. And that's what we need to see. Just like with Amazon, AWS actually brings in the majority of the income for the entire company. And it's such a small percentage of the revenue because it's a ridiculously high margin business. Same thing can happen for SoFi as they scale the technology platform larger and larger. As they scale it more, it's going to become even more profitable. That high margin business is going to spin off so much cash. And over the next 3 to 5 years, we could see a similar situation where the tech platform is spinning off the most amount of profit, even though it's not going to be the most amount of revenue in terms of segment. And then lastly, we've got financial services. This is the real growth engine for SoFi right now. 80% increase in revenue year over year from $98 million up to $176 million. Attributable expenses are rising as well, but not nearly 80%. They only rose 18%. So when we have revenue for the segment increasing by 80% and expenses for the segment only increasing by 18%, once again, contribution profit is going to explode. They swung from a loss of $4.3 million in the year ago quarter to a $55 million profit. That's a nearly $60 million swing within a 4-quarter span. Absolutely ridiculous, insanely impressive. And I'm excited to see that Nodo's financial services productivity loop strategy is absolutely paying off. The more they can grow the financial services products and revenue, the more they're going to be able to port someone out to another service that they offer. Maybe a home loan, maybe a student loan, maybe a personal loan, maybe their credit card product. So their strategic investment in growing financial services is paying off in a major way. And I can't wait to see what they can do as rates come down and the economy gets in a better spot. And then we've got the guidance numbers that the management team gave us. We've got third quarter adjusted net revenue. This will be a record of somewhere between 625 to 645 million, adjusted EBITDA in the range of 160 to 165 million, and net income of 40 to 45 million, which would be 4 cents of EPS in Q3, which would then be 4 consecutive quarters of GAAP profits for SoFi. So assuming they're able to make that happen, technically after Q3 of 2024, SoFi is going to be eligible for S&P 500 inclusion. I think it'll be quite a while before SoFi actually gets the inclusion. We've got quite a few other stocks that I'm looking at that I think are going to get added well before SoFi, but technically they will be eligible if they're able to deliver on their guidance in Q3 of 2024, which is extremely exciting. Now let's move on to full year 2024 guidance. They raised their full year revenue guidance by about $35 million, which implies somewhere in the range of 17 to 19% revenue growth. Not the number I love to see, but I understand why it's lower than it has been in past quarters. We're in a tight financial time. And for now, like I've said like 3 times in this video already, the majority of their revenue is coming from lending. Lending is tight right now. That means the revenue growth numbers are going to be a little bit depressed for a while. I see the revenue growth getting back into the 20s and potentially even touching back into the 30s as rates come down and the economy gets in a better spot. Speaking of lending, the 2024 full year guidance has now been updated to at least 95% of the 2023 lending revenue levels for 2024. This is up from somewhere between 92 to 95%. I was looking for a little bit bigger of a raise on the guidance based on Anthony Noto's comments, but it is nice to see a revenue guidance raise for the lending segment. If they were able to come out and say that lending was going to be flat year over year, I think the reaction to the earnings would have been much more positive. And of course, if they would have said, hey, just kidding, we're actually going to have growth in the lending segment, then definitely the reaction would have been much more positive. Because remember, Wall Street's what's moving these stocks in the short term. Wall Street cares about the next 6 to 12 months way more than they do about the next 6 to 12 years. And then for financial services for full year 2024, we had a guidance raise up to more than 80% for year over year growth. That's up from their prior guidance of 75% year over year growth in financial services. And then unfortunately, they actually lowered their tech platform revenue guidance. Prior guidance was for 20% growth for full year 2024, and now they're saying mid to high teens for the tech platform revenue growth. Not great to see, but as long as they can keep bringing those attributable expenses down and we've still got growth, then I'm going to be happy as long as they can accelerate that growth in future quarters and future years. And last guidance piece I want to talk about that is definitely positive. They've raised their GAAP EPS guidance to a range of 9 cents to 10 cents, up from a prior range of 8 cents to 9 cents. Only 1 cent of a raise, but any raise is good when a company is in the process of flipping that profitability corner and we're in a tight economic time with rates as high as they are. I'm very glad that SoFi is focused on keeping those GAAP profitability quarters rolling, and they're even able to increase those guidance numbers. You and I know that stocks follow earnings over the long term. It might not be perfectly correlated in the short term, but if a company's earnings are getting in a better spot, the stock price is going to get in a better spot. Sometimes there's a 6 to 12 month lag on that, but that stock price is sure to follow wherever the earnings go. What am I doing with SoFi personally? I have been making very, very small buys on SoFi. I think SoFi is extremely attractive anywhere under $7. Even a little bit above $7, I still think it's pretty attractive. As we get into the $8, $8.50, and $9 range, I think it's a little bit less attractive, but I still might pick up a couple shares here and there. My cost basis is so low, and I'm buying small lots of shares now that it's not like it's going to destroy my cost basis or anything like that. I'm holding 100% of my shares. I'm still buying a very small number of shares, like I said, because this is a really large position for me. Just like Palantir, I built it way larger than I thought I was going to because I've become more and more bullish, and we've gotten so many opportunities to add SoFi at attractive levels that I haven't been able to resist. And then the last stock I want to talk about is PayPal. It's been a minute since I talked about PayPal, and it's because it's a value stock, and I don't see it as a massive growth opportunity personally. I don't expect to get like a 3 or a 4x on my shares. I don't even expect to hold this stock for the next 7 years. I'm planning to hold this stock for the next maybe 3 years, to be honest. I view this as a value play. I view this as a turnaround play. I first bought my shares when I saw that the PE was so ridiculously low in comparison to the growth rates that were expected. That's still the case. A gap forward and trailing PE of less than 15 is still much lower than the market as a whole, specifically the S&P 500. Revenue growth of the average company inside the S&P 500 is also being beat by PayPal, somewhere around 8%. And PayPal has much higher earnings per share growth and operating income growth than the average stock in the S&P 500. It's still an attractive company from a value-focused perspective, in my opinion. These are all GAAP numbers: 8% increase in revenue, 17% increase in operating income, 17% increase in EPS. In just Q2 alone, they repurchased $1.5 billion worth of stock through their share repurchase program, which is going to help those EPS numbers in a major way. When we take shares off the market, the EPS numbers are going to go up, which is great because over the long term, stocks follow earnings. Share buybacks help stock price in an indirect way because they're going to increase EPS, which brings that valuation down. This is a strong quarter, and I'm pretty impressed with Alex Chris's ability to come in with beats on a consistent basis. If we look at the past 4 quarters since he's been CEO, they had a beat Q3 2023, they had a beat Q4 2023, they had a slight miss in EPS, but a beat on revenue in Q1 of 2024, and then a massive beat in Q2 of 2024, which they just reported. If they can keep that trend going, and it's going to be helped even further by continued share buybacks of over $6 billion of shares being repurchased in 2024, that's going to put the stock in a really good spot over the next few years. I like the stock a whole lot. under 60. I like the stock above that as well, but it's gonna be a smaller buy for me above 60 than it would be below 60, of course. Maximum percentage of my portfolio that I'm putting in PayPal is 4%. I'm not quite to that spot yet, so I am still picking up shares of PayPal. Very disciplined. Prefer to buy on red days, obviously, rather than green days. My cost basis for PayPal is right at that $60 range, and over the next 3 years, I expect somewhere between a 70 and 80% increase from here. That's my personal expectation. Let me know if you own any of these 3 stocks. If you bought more after earnings, before earnings, if you sold into the strength, if you bought into the strength, I want to hear what you did with these stocks, or if you're doing any options plays out there. One of my favorite parts of posting here on YouTube is having some conversation with you guys in the comment section. It's good to be back. I appreciate you being here in a major way. Thank you so much and have an amazing day.